In our previous video, Interest on Interest, we introduced the concept of put options. We will now go deeper into put options. What is a put option? As a seller, you offer to buy shares at the price you decide within the time frame you establish. The buyer has the option, but not the obligation, to put the shares to you at the agreed price within the established time frame. Why selling a put option? If you have decided to buy some shares and you are of the opinion that today they are good value for money, by selling a put option you get to buy shares in the future at a discounted price. For this offer to allow shares to be put to you, you get an income called premium. The price you decide the shares to be put to you is called strike price, and the end period of this contract is called expiration date, normally the third Friday of each month. The best moment to sell put options is when the share price is low and it looks like it's going to go up. Put option premium moves the opposite of share price. Thus, as share price goes up, option premium goes down. As an approximation, for every $1 the share price goes up, the put premium decreases by $0.50. Likewise, for every $1 the share price goes down, the put option price increases by $0.50 approximately. When we sell a put option, there are 6 possible outcomes. Number 1, at expiration, the share is trading above the strike price. In this case, the shares are not put to us and we get to keep all the put premium. Number 2, at expiration, the share is trading below the strike price and we want to own the shares, therefore we allow the shares to be put to us. Number 3, before expiration, the shares went up and this caused the put to reduce to 20% or less. We can decide to close the position and keep this 80% or more of the initial premium. Therefore, we can sell puts at the bottom and buy them back at the top and continue this process over and over. Number 4, before the expiration date, the shares get put to us and if we decide we don't want to own them, we can sell the shares back to the market and open a fresh put of the same or a lower strike price for a net profit. Number 5, close to expiration, we decide not to take delivery of the shares. In this case, we can push forward the contract to a future expiration date for a net credit. And number 6, at any time we can place a lead, that is, we can buy a put at a lower strike price with the overall results of a net credit. This strategy is called bull-put spread. Leads are cheaper to buy as share prices go up and they release buying power that can be used for other trades. Find us at Empowered Supernova and www.ticn.ie. For more information, contact us at anna@ticn.ie, ana@ticn.ie. Thank you very much.